All views, opinions, and comments expressed herein are solely those of the speakers and do not necessarily reflect the views or opinions of StoneX Group Incorporated and/or its subsidiaries. This content does not constitute an offer or solicitation to open a trading account, to trade in any specific product, or to engage with any services provided by StoneX Group Incorporated or its subsidiaries. This content is not intended for residents of any particular country or jurisdictions where such content is prohibited.
Welcome to the Trading Global Macro podcast from StoneX, where we unpack the complex forces driving global financial markets. I'm John Kicklighter, Global Head of Content at StoneX.
And I'm Matt Weller, Global Head of Market Research for StoneX's self-directed brands. Each week in this podcast, we explore the macroeconomic trends and geopolitical events shaping Forex, equities, commodities, interest rates, and more. And we have a good topic for you guys today. I might even say it's a bit of a seasonal topic. John, what are we discussing today?
Yeah, well, with the cat out of the bag, it's seasonality. So we're going to talk about some of the norms that you'll see if you're new to trading, if you're experienced, obviously, talk about them a lot. But we're going to look at the typical expectations that come with changes in season. Now, we say season, and that's usually an annual thing, which we will definitely cover. I think one of the most pressing ones that we're talking about at the time of this recording is going to be the Santa Claus rally, where assumptions are running very high, given the surrounding circumstances. But seasonality can actually be at a different scale. It can be down on an intraday basis, for example, which we will talk a little bit about. But I think that this is a great place to start. But let's talk a little bit about what seasonality actually is. Matt, how would you define seasonality?
In an ideal situation, I would say seasonality is sort of a recurring trend that you see at specific times of the day, of the week, of the year. And many traders believe that they can get a bit of an edge by identifying what's happened in the past and applying that to the future. And in many ways, that's what other forms of technical analysis and trading and even fundamental analysis can be. So I always like to say, and I'm sure you'll add to this, John, but I always like to say seasonal tendencies are exactly that. They're tendencies. Using seasonality as a tool, not a rule, is something that I like to keep in mind, because it's something that can complement other forms of analysis. But oftentimes we see people say, oh, we're coming into a strong seasonal period, so we'll just buy. But really, you have to consider it as a supplement to other forms of analysis. If it's in a bullish technical period and the fundamentals are supportive and we're entering a bullish seasonal period, maybe that can give you a little bit more confidence, but it's not necessarily something that you want to rely on in isolation. And that would be my 60-second overview elevator pitch for seasonality. What would you add to that, John?
I think that was very well put. It's a tool and not the rule. It's complementary, because I myself, having spun a couple decades of trading and investing in analysis, I don't like to commit to just one form or technique of analysis, and I've practiced all of them, and technical analysis, fundamental analysis, quantitative analysis, but I even put market conditions as a separate node of this, and oftentimes seasonality is often just pulled into technical analysis or fundamental analysis if you're talking about crops and such. But I think in the way that we're talking about seasonality is these circumstances that run a little bit more deeply. They don't, if you put it into technical or fundamental analysis, it often gets buried and it's just seen as a footnote, when in fact it can be a prevailing consideration, like the perspective of risk on, risk off, or sentiment, which we covered in its own podcast episode. So I think it's really important to look at seasonality in those terms, and I think you defined it fairly well. But I think it's important to also understand that this can be a phenomenon on multiple timeframes. So if we look at something like the, let's say, S&P 500 E-mini futures, because it has a continuous ongoing market, if you turn down the time frame to, say, like an intraday time frame, like a 60-minute chart, what you'll find is that there is a seasonality, if you will. We don't usually refer to it as such. We call it sessions, but there is a session by session activity change, which has a profound impact on how that market performs. So If you're looking at, let's say, overnight, I'm saying that from the perspective of somebody that's in the United States. Overnight, it starts with the Tokyo session. And as Tokyo comes online, activity and liquidity come in from the Asia world, and it starts the markets off. And they are often referring back to what happened into the previous US session to dictate that first opening move. And then subsequently, developments in that area will start to unfold. Things that are happening in Tokyo or China or Australia, profound things that are global macro and inclined, which is why we're looking at something like the S&P 500 because it is a very global market benchmark. And then we get into the London Open, so European markets really coming online in earnest with liquidity, and then it gets into the New York session. That New York session is when things really start to pick up, and that's where you get the vast majority of your volatility for the day, because the London New York crossover is peak liquidity, peak volume, and then you get the most potential of volatility as it also aligns to some of the morning releases of U.S. event risks, like traditional non-farm payrolls. That doesn't happen all the time. But generally speaking, when you break out the averages of a day's session, that's what you see, and that's fairly probabilistic liquidity, and that's fairly probabilistic seasonality in that feature. So you have actually an intraday seasonality. It's not just an annual factor, and then you also have weekly norms. Do you want to talk about some of the weekly norms, Matt?
Sure. And I like just to frame your commentary there on the daily sessions. It might be review, perhaps, for a lot of listeners, but I love how you kept going back to why. Why are we seeing this? And I think that's an important thing to keep in mind when you're looking at seasonal trends across any time frame, because a lot of times you can get fooled by randomness. Over the last 20 years, something might have happened every December or most of the Decembers for a market, but that might just be random noise. So you don't want to read too much into that. And that's something that I use as a broader framework. So spinning that forward to, for example, weekly seasonality, if you will, one thing that comes to mind is oftentimes ahead of the weekend. That's when markets are closed. That's when traders perhaps won't have as much liquidity or any liquidity if they want to get out of a position. One thing I think that we tend to see commonly is profit taking. So that could be a situation where maybe the stock market's been up the first 4 days of the week. A lot of times we might see shorter term traders take their profits rather than risk holding those trades into a new week. Who knows what's going to happen over the weekend, and that could be at risk. It feels much better to go home with a clean book and some cash in your pocket. But that can also apply the other way. If shorts have been making money on the downside, perhaps they look to cover those positions heading again into the weekend. So that's one of the ones that comes to mind. And then maybe as we move forward to the next week on Monday, there often tends to be a flurry of activity right at the open because we're sort of consolidating 2 or 3 days worth of new news developments into market prices, oftentimes in the first 15 or 30 minutes of a trading day. So those are some that come to mind to me. Was there anything else specific you were thinking about from a weekly perspective, John?
From seasoned traders, I often hear they have expectations around Tuesdays and Wednesdays, midweek activity and lulls. But I think that those are probably the best examples because you're talking about a consistent liquidity ebb and flow. And even when you're talking from day to day, the session closes or the day closes, and you reset a clock and a calendar, a candle on a chart. Expectations come with that, and then you see people like some of the people we work with are more purely technical analysis. That formation of that candle sets off expectations on what happens next. But I think when you start getting into the higher time frames, that's where people really start to experience more of those expectations of seasonality. So I'll save the annual for you next, but for even the monthly. So in monthly time frames, you have consistencies. You have things like funds will have to do rebalancing, and sometimes they do it on a monthly or even a quarterly basis. Quarterlies tend to be much more dense, but then you also have derivative expirations. So if you're looking at something like a crude oil contract or a gold futures contract, especially those contracts that are for agricultural goods or softs or energy goods, things that will essentially be used and evaporate, and then they'll move on to the next harvest or the next refining process. They will actually have a need for that contract expiry to roll over to the next contract. And you also have it on options as well, which is the derivative speculative effort around the price expectations of those underlying futures or even underlying spot products. And those are fairly consistent. But again, on the quarters, you're going to have a lot more liquidity, a lot more volatility because you have much larger contracts. You end up having something called triple or quadruple witching, which is where you have the different variations of derivatives all expiring at once, and big products as well, like financial products that tend to more expire on the quarters rather than the months. That's where you get a lot of out of the blue volatility for people that are not familiar with derivatives markets. But I think that most people are going to be familiar with the more of the annual seasonal considerations. You want to talk about that a little bit, Matt?
Sure. We'll go chronologically through the year and sort of build suspense heading into December as we record this now on December 1st. One that you commonly hear about is the January effect when it comes to the U.S. stock market. That's when we see general bullishness in January. And again, I'll always go back to these explanations. It doesn't mean they're going to work in the future, but I think if they have this explanation behind them, that they're more likely to persist. And one of the factors there is that there tends to be people buying back stocks that they had sold at the end of the year. Maybe they sold to take a tax loss. Now they're buying them back because they do want to own them long term, but it was just temporarily advantageous to realize a loss in the previous year. We tend to see that, at least the academic research shows, especially in smaller cap stocks, which tend to be more volatile already. So that's something to look into and be aware of. Looking a bit further down through the year, there's the summer doldrums. Basically, the proverbial head traders on Wall Street go out to their cabins on the Hamptons and are away from the desk, and we tend to see lower volume, sometimes lower volatility. But anytime you have lower volume, that means if there is big news, you can actually see more volatility, as it doesn't take as much money flow to lead to more market moves. And then maybe the main focus of today's chat would be the Santa Claus rally. Now, traditionally, that actually, the original Santa Claus rally only refers to the last 5 trading days of the year and then the first 2 days of January. But that's generally, as the name suggests, a bullish tendency. And some of the explanation for that might be general holiday cheer, which I don't buy too much into. I'm happier on the holidays, as is everyone, but I don't know if that impacts my financial decisions. But there's also a bit of a performance chasing aspect where these large, for example, mutual fund managers in the U.S., as we're coming into the end of the year, they don't want to have to explain when they close their books why they don't own some of the big winners from the year, NVIDIA being the quintessential example, or maybe now Google, given some of the movements we've seen in the last month. So those are some of the big ones that I would be aware of. What else is on your radar, John?
I would say in addition to that, we also have things like the sell in May summer doldrums. So when you look at something that has a volatility consideration, you do have a continued drop into June and July when you look at the historical average, monthly average of the VIX versus the performance of the S&P 500. And I think that while each year can be different given the circumstances, obviously we've had years where this was definitely not true, back during the global financial recession, for example. But you do average that out over time because exactly the conditions that you were talking about, people were moving away from or going on vacation or just expectations that have formalized and formulated over the time to give you that kind of average. And you can see that trough happens in July, and sometimes it's exacerbated. I think 2017 is a great example of. I mean, I was twiddling my thumbs as an analyst and trader at that time. It was just dead. So it can be really exaggerated, but generally speaking, it turns into a revival of fall activity, and then I think it lasts until about what I consider to be the Thanksgiving coma, where you go into those year begin trends once again. Now, again, to your point, these are certainly habits or trends or probabilities. They are not the certainty, and you have to know and understand your context. This time around to this year, going into the year end, we do have a lot of the hallmarks of the same kind of conditions. Markets are aligning to those expectations. Fundamental themes are not as prominent. The markets are not consistent with something like tariffs, which have fallen off, or rate expectations, which, while are certainly interesting, we have a gap in interest and momentum, and there's some distortion between the different regions around the world. So things like that can contribute to a move back to those averages, back to those norms. And that's always what we're looking for. We're trying to put the seasonal into the context of the fundamental and technical so they get something a little bit more consistent. Anything else you'd add to that, Matt?
Maybe one closing thought would be to touch on something that impacts all market anomalies, if you want to call them that, and that's what's called the publication effect. Basically, as more people become aware of these deviations from the averages, they tend to start to anticipate them, and in so doing, sort of erase that impact. And that's something we've talked about a couple times on recent podcasts. But if there was a consistent every year rally in a specific window, well, people would just buy ahead of that, and then prices would be higher. Perhaps that rally wouldn't occur on that same time frame, and it might be more spread out. So I think just being cognizant that even if it happened in the past, even if it has a good explanation, the impact is unlikely to be as big of a deviation as it was in the past, just by virtue of you hearing about it, unless it's a novel discovery on your own. So I would always, again, just kind of manage expectations. It can be a very valuable tool, but seasonality is not a rule, and its impact over time it tends to fade, as with all market anomalies. So that would be the last piece of wisdom, hopefully, I can impart.
Absolutely. Well, thanks for tuning in to the Trading Global Macro Podcast for Senex. If you enjoyed today's discussion, make sure you subscribe wherever you get your podcasts. I'm John Kicklighter.
And I'm Matt Weller. Join us again next week for more insights into the trends and events shaping the world's financial markets. Thank you.